Bullish or bearish on the U.S. economy? An investment perspective with global context. The U.S. economy remains a polarizing topic for investors and analysts alike, with compelling arguments on both sides of the bullish-bearish spectrum. From an investment standpoint, there are reasons to be cautiously optimistic about the U.S. economy, yet underlying structural challenges and global shifts raise questions about its long-term dominance. Let's unpack the key drivers, historical context, and practical implications for investors. Bullish indicators, the power of the reserve currency. One of the strongest arguments for a bullish outlook on the U.S. economy lies in the enduring status of the U.S. dollar as the world's reserve currency. This unique position allows the U.S. to effectively export inflation by printing money as global demand for dollars, whether for trade or to hold U.S. treasuries, keeps asset prices elevated. Historically, since the Bretton Woods Agreement of 1944, the dollar's dominance has underpinned U.S. financial markets, driving consistent growth in equities and bonds. Even amidst challenges, the dollar's role as a safe haven ensures foreign capital flows into U.S. assets, a trend that has supported market resilience through crises like the 2008 financial meltdown and the 2020 pandemic. Moreover, the U.S. remains a hub of innovation and corporate strength, particularly in technology and finance. Companies like Apple, Microsoft, and Nvidia continue to dominate global markets, reinforcing investor confidence. The S&P 500, a proxy for U.S. economic health, has delivered annualized returns of around 10% over the past decade, outpacing many developed markets. This suggests that, despite short-term volatility, the structural advantages of the U.S. economy, its deep capital markets, entrepreneurial ecosystem, and military influence will likely sustain asset price growth for the foreseeable future. Bearish concerns, eroding purchasing power and global competition. However, cracks are appearing in this bullish facade. The U.S. dollar has experienced a notable decline, with the DXY index, a measure of the dollar's strength against a basket of currencies, dropping 10% in 2025, marking one of its weakest years since 1972. This erosion of purchasing power means that even if your investment portfolio gains 14% year-to-date, your real return might only be 4% after adjusting for the dollar's depreciation. For everyday Americans, this translates to a harsh reality. If your income hasn't risen by at least 10% this year, you've effectively lost ground. This decline is compounded by growing competition from other global currencies, notably China's yuan, which is positioning itself as a viable alternative. While the dollar's military-backed dominance has historically secured its status, this definition is shifting as geopolitical tensions and economic policies like tariffs weaken confidence. Additionally, domestic inflation, fueled by expansive monetary policies, continues to outpace wage growth for many, forcing individuals to invest in markets just to preserve wealth. This forced participation in equities creates a feedback loop of asset inflation, but also exposes investors to heightened risks if confidence falters. Sector-specific impacts and global trends. The interplay between currency strength and asset classes is critical. Gold, often seen as a hedge against inflation and dollar weakness, has matched the performance of Berkshire Hathaway over the past 25 years. A staggering statistic that underscores a lack of faith in traditional equity outperformance. This trend reflects a broader shift towards safe haven assets as investors grapple with overvalued stocks, volatile cryptocurrencies like Bitcoin, and expensive real estate amid high interest rates. Meanwhile, sectors like energy and consumer goods show mixed signals. While gas prices have dipped slightly, grocery costs remain stubbornly high for many, despite the dollar's decline not fully translating into retail price hikes. Globally, the U.S. economy's trajectory impacts emerging markets and developed economies alike. As interest rates decline, a move that further weakens the dollar, foreign demand for U.S. treasuries may wane, potentially triggering capital outflows from U.S. markets. This could disproportionately affect tech-heavy indices like the Nasdaq, which rely on foreign investment, while benefiting commodity exporters in countries tied to a stronger local currency. Historical context. Lessons from gold and inflation. Looking back, gold's performance offers a sobering lesson. If you invested in gold in the 1980s, your inflation-adjusted returns today would be flat after nearly 5 decades. This highlights the cyclical nature of safe haven assets and the risk of timing markets poorly. Similarly, the dollar's current weakness echoes periods like the 1970s, when stagflation and geopolitical uncertainty eroded confidence. Yet, the U.S. economy has proven remarkably resilient, often rebounding through policy innovation and market adaptability, a pattern investors should weigh against today's challenges. Conclusion: investment implications and near-term catalysts. For investors, a balanced approach is essential. While the U.S. economy offers bullish opportunities, particularly in tech and growth stocks, hedging against dollar weakness through gold, international equities, or inflation-protected securities is prudent. Diversifying geographically, perhaps into stable economies like Switzerland or Japan, could also mitigate risks tied to U.S.-specific challenges. From a policy perspective, the Federal Reserve's balancing act between inflation control and economic growth will be pivotal. Investors should monitor upcoming rate decisions and geopolitical developments, as these could either reinforce the dollar's status or accelerate its decline. Near-term catalysts to watch include the Federal Reserve's next policy meeting, potential tariff escalations, and China's progress in internationalizing the yuan. A stronger-than-expected U.S. jobs report could bolster confidence, while any hint of de-dollarization in global trade could pressure markets. Ultimately, while the U.S. economy retains structural strengths, the road ahead demands vigilance and adaptability from investors navigating this complex landscape.